Welcome to the New York City Bar Association podcast. Opinions expressed are those of the speakers and not necessarily of the City Bar.
Thanks for tuning in. Today we are going to discuss a recent notice of proposed rulemaking issued by the Department of Treasury related to the Genius Act. My name is Tiffany Smith. I'm going to be your host today. I'm a partner at WilmerHale in the Securities and Financial Services Department. I'm also co-chair of the firm's Blockchain and Cryptocurrency Working Group. In addition, with respect to the New York City Bar, I'm one of the co-chairs of the Presidential Task Force on Artificial Intelligence and Digital Technologies. Today, I'm joined by Beth Haddock and Boaz Goldwater, who are going to be discussing the different parts of the rulemaking. So let's take a minute to let them introduce themselves, starting with Beth.
Thanks, Tiffany, and thanks for your leadership in all of the crypto and artificial intelligence task force. There's a lot of great work there. And I'll start by saying I'm also involved in that group. I'm a director and an advisor, and I have been working with digital asset firms for about 10 years. Prior to that, I was working in traditional finance as the head of regulatory compliance.
Excellent. Boaz?
I'm Boaz Goldwater. I'm an associate in the Davis Polk Financial Institutions Group. I've had the pleasure of debating many of these issues through various task force meetings over the past couple of years. So looking forward to today's conversation as well.
Excellent. So both to you all for both your role in the task force and for joining me today to discuss this rulemaking. So to set the stage, Boaz, can you give listeners some background on this rulemaking and what it does?
Sure. So obviously last year we got our first federal legislation related to crypto assets, and specifically the Genius Act, which regulates or sets the statutory framework to regulate payment stablecoins. So essentially stablecoins that have a dollar value and are intended to be used in payments. It's an interesting structure, and the Genius Act provides for both federal payment stablecoin issuers and state payment stablecoin issuers, as well as a subset of qualified foreign ones, but we'll leave those to the side for now. And part of the regime as between federal and state qualification provides that Treasury has a role in promulgating sort of guidelines for what a state regime can look like so that it qualifies under the Genius Act as sort of comparable to the federal regime that is more detailed and more explicitly provided for in Genius. And this rulemaking is, notice of proposed rulemaking is Treasury's attempt to provide those guidelines for what a permitted state pathway to being a qualified payment stablecoin issuer would look like. And there's loads more details that I'm sure we'll get into, but that's sort of the high level background.
And can you address a little bit how this framework of having both a federal framework as well as a state framework kind of dovetails and kind of relates to existing regulations?
Sure. So the most obvious analog is banking. We have the dual banking mandate. So you have federal banks, you have state banks, federal banks, chartered, licensed, supervised by the OCC, state banks, chartered by their state regulator with a dual supervisory mandate for the state regulator, as well as either the Federal Reserve or the FDIC. So it most closely maps to that. There are important differences here, as we'll get into. One can move from state regulation into federal regulation while maintaining state regulation here. It's a little odd, but we'll get into that. Whereas at the banking level, if you were to convert, for example, from a state bank into an OCC chartered bank, you would completely remove your state regulation as your sort of core supervisory team. So there's an interesting parallel, but it's not perfect.
Excellent. And Beth, let's bring you into the conversation. What was the purpose of providing a pathway for state regulation?
Yeah, thanks, Tiffany, and thanks, Boaz, for the overview. When I think of New York, right, most of our audience are going to be in New York, as well as Wyoming and some other states have taken leadership in the space. So when I think of these two paths, it's not only to allow for smaller innovators, but also to give a nod to the states that have been pretty proactive, just like New York, and gone ahead and already have payment stablecoin licenses that they have issued under their state laws. The analogy I think in banking is interesting, but also we see it in securities and investment advisory, where we allow for innovation, we allow for an easier entry into a new space by really promoting sort of regional or local growth before you're at the point where the business plan might either grow to be national or even global, where the federal pathway just might be a better fit for what the new enterprise is looking to do.
Excellent. And here I think the level at which a stablecoin issuer can opt for state regulation, I believe it is the 10 billion level.
Yeah, of the outstanding issuance. So it really is this size where you would then hop up, as Boaz had mentioned. And I do think, just to reiterate, it's if you're considering which path, I do think it is driven by what the business plan is, as we see in some of these applications, even for the payment stablecoin license. If, by way of example, if it is a local bank, a community bank, perhaps the OCC option isn't as favorable as one of these state options. So this rulemaking and the Genius Act, I think it's great the way it leaves optionality and possibilities there.
Yes, I remember that. And so I recall that before the Genius Act, there was clarity. And one of the big things that was heavily debated was the role of states in stablecoin regulation. So where we landed was a compromise where the state regulatory regime has to be substantially similar to the federal one. So can you talk about what that means in practice in the relevant requirements of the Genius Act?
Sure. So and it's interesting that the proposed rulemaking highlights that in some respects, substantially similar means that the federal regime is a flaw, and in others takes great pain to say that it isn't a flaw. It really is a flaw in all sort of substantive respects and permits deviations only in non-substantive respects. So it's interesting in that it has to be consistent with the federal regulatory regime in all substantive respects really means it needs to be the same. That's not what the proposal says, but I think in practice, that's what we'll see, because I don't think there will be that many states that actually implement new regimes. As Beth said, this is sort of New York led the way and will come full circle because Genius very much reflects what New York had already done in its stablecoin guidance. And now is sort of throwing it back to the states, saying you have to meet what the Genius Act says and what the OCC says. So specifically, there are a number of statutory requirements in Section 4A, mostly Section 4A1, but other sections of the Genius Act that are sort of the core requirements. So these relate to reserve assets, redemption requirements, publication of reserves and attestation and the like. And then there are some other things: capital liquidity, reserve, diversification requirements, BSA requirements, and whatnot. And the proposal divides these into two sections. So one is what they call uniform requirements, which strictly needs to be the same as what is required at the federal level, which the proposal defines broadly as anything in the Genius Act and anything that the OCC publishes in the Federal Register. And then the second category are this, quote, state calibrated requirements, which is where where the Treasury sees there being some more room for deviation. But again, it's not a substantial deviation. So it must be, I forget the exact phrase, it's sort of at least as protective as, along those sort of lines. So again, it's a flaw rather than a strict rule, but there are subtle differences between what must be very strictly uniform and what there is some room for deviation.
Interesting. And Beth, can you highlight some areas where states have meaningful discretion and versus those where they're expected to track very closely to the federally regulated standards?
Sure. Before I do that, maybe just to follow on Boaz's comments, when I take a look, I sit on a board of a DFS regulated payment stablecoin. And when you look at how DFS has been leading, Like you could just take one example to make it a little bit more pragmatic for the audience, which would be AML requirements. So New York Department of Financial Services, as a state, obviously, has been requiring that all of its licensees follow the federal requirements for AML, KYC, and sanctions, even as there's been some pretty heated debate about what is the appropriate standards. So hopefully that gives a little bit more context. And then when we think about where does the state have discretion, there are things that are like licensing, supervisory procedures. And as Boaz had mentioned, it's a yin and a yang. It's also a standard, but then you give a little bit of discretion to the states on things like calibrating capital, liquidity, and some of the risk management standards. So when we think about how a state would decide to examine and how a state would decide to enforce these different requirements, that's where a lot of the discretion will come. But of course, at the same time, that discretion needs to align with the floor, as Boaz had talked about, because how else would one meet the threshold of being substantially similar? And so you really do need to stay at that level as well as using your discretion so that you're able to operate how you operate within your local jurisdiction.
And I mean, in some respects, it seems like a moving target, right? Because the federal standards are still evolving, yet the states have to be substantially similar, right? And so, like practically, how do you sort of think? How do we sort of think of those two things? Like, right, both of them are moving, yet the state you have to kind of meet some type of level or floor. So, if, like from a practical perspective, do you have any thoughts as to like how firms or stablecoin issuers should deal with these competing demands?
Yeah, it's interesting, at least from my perspective, it's not a wholly unique challenge for lawyers and compliance professionals in that if you get rules-based requirements, there's going to be some ambiguity. So I think the first thing is we have this webinar to let everyone know this is a moving target. It's something to watch, but whatever you build now will need to be recalibrated as we have experience and we have additional guidance. And generally, let's just say one was to start a plan as to how you're going to adhere to all of this. It would be to get the framework because we do have the framework and the foundation, whether looking at New York or other jurisdictions, as well as a lot of what's out there on Genius, and knowing 20 to 30% is going to have to be calibrated based on the developments that we anticipate. And there are some of them that are core to what I would say if you were to do a risk assessment also to make sure you understand low, medium, and high risks of the enterprise if you're going to move ahead in this type of environment that really has the moving target, run risk, things like that. You do need to make sure that you have a good discussion and decide perhaps to be more conservative in the interim, and then you adjust once there's more clarity about those kinds of operational resilience issues.
Excellent. And Boaz, the proposed rule talks about an interagency stablecoin certification review committee that's supposed to be involved in the process of making substantially similar determinations. And can you talk about how much discretion you think that committee will have?
I think it's quite a lot of discretion, both at the committee level and on an individual basis, because every certification needs to be unanimous, I believe. So any individual on that committee effectively has a veto. There's almost a difference between the initial certification review and the recertification review. So level recertifications are required, I think it's annually. And there's a slightly different standard for the initial certification and the recertification. So for the initial certification, it's everything that's in the proposed rule. So does the state level regime meet or exceed the standards and requirements, et cetera, et cetera. But for recertification, and that might be a moving target. So if you don't have a state regime right now, you have to really focus on what the OCC is doing because you have to meet their requirements effectively for all the uniform parts of Section 4A. But for a recertification, the committee can only deny recertification, and I'll quote from the Act itself, if the state level regulatory regime has materially changed from the prior certification, or there has been a significant change in circumstances, which is sort of slightly different because you could have a scenario where the OCC rule changes and therefore the state regime is no longer in compliance with what the OCC has published in the Federal Register. But the state regime hasn't changed. There hasn't been a change in circumstances at the state level. So it's a little ambiguous to me as to what happens in that scenario when there are changes to the OCC regime after certification as compared to changes prior to certification while states are going through their own rulemaking process.
Yeah, those are all good points. I think practically it could make it very difficult for a stablecoin issuer, right? Because you're running a business, like, right? And so for the target to change in some respects, and you have, really no notice maybe, or like really no say, it seems like practically that can cause issues. So I think you're really highlighting something that's worth firms and potential issuers commenting on. So Beth, back to you. So one of the cornerstone requirements of the Genius Act is that the payment stablecoin issuers maintain high quality liquid reserve assets back in their stablecoins. What do the reserve requirements look like for issuers regulated under a state regime?
So this is, reserve assets are one of the most important components for what I was calling operational resiliency and to make sure there isn't any run risk. So this is one for the state regulated issuers that it's what I think Boaz was calling the core uniform requirements. So they have to stay very close to the federal framework. And what that means is that there really is this statutory list of what are cash-like instruments, and the states don't have the discretion or the ability to go beyond that list unless they go through a process for approval. And we've already seen that in the payment stablecoin market when you have seen, and even outside of the US, you see a big debate in the UK and in other jurisdictions about what is appropriate to be treated as highly liquid. Currently, for instance, like mutual funds, money market mutual funds are in that list. So it is to be seen, sort of as a lot of the other topics that we've already talked about, as we get experience, truly whether or not that'll be a static list that's at the federal level and the states will follow, or over time, we'll see different trends and practices with regard to diversification and with regard to the definition of liquid. So this way you can meet those liquidity requirements.
And how does the proposed rulemaking approach capital liquidity requirements for state qualified payment stablecoin issuers? What limits does Treasury put on state discretion in this area?
Yeah, I think I covered a little bit in the last question, but I would say those are the areas that you cannot weaken the federal standards. So there is some discretion, but you have to hit that floor that Boaz was talking about. So there's a list of what type of capital as defined, but then you have to maintain different adequacy processes and keep an operational backstop. That's at least at that federal level. So it's that balancing act of having discretion, but with the floor. And on liquidity, these are like two of the most important issues to make sure that these payment stablecoins operate as designed and don't create any kind of systemic risk as they grow. The states can choose their own approach, but it has to have at least the same stringency as that federal level. So essentially, there's a little bit of flexibility on design as long as the federal standards are adhered to.
Excellent. And as we discussed briefly earlier, Boaz, the proposal contemplates that a $10 billion outstanding issuance threshold is where state-regulated stablecoin issuers must transition to federal supervision or cease issuance. How is that transition to federal oversight expected to work in practice under the proposed rulemaking?
So the short answer is nobody knows because it's never happened before. It's a brand new concept. It's a brand new type of entity, a non-bank payment stablecoin issuer reaching a threshold that would be forced to transition into OCC regulation. It's just new. The Treasury proposal talks about what the states must do to facilitate this, which is effectively don't get in the way. they can't, propose any rules or requirements or have a framework that makes it overly onerous to do this transition. Most of the detail, I think, is in the OCC's recent Genius Act implementing proposal, which again, the OCC proposal was almost 400 pages. And I think there were 2 or 3 pages devoted to this. And it effectively just says you're required to provide written notice and provide a plan for your own transition. It's very bare bones. So I guess I said the short answer is nobody knows. I think the long answer is also that nobody's quite sure. So we'll see how it plays out in practice. But the most interesting thing, I think, is that for non-bank state issuers who transition to OCC regulation, they will also keep their state supervision. So that's, like I said at the top of the podcast, totally different from a state member bank, for example, transitioning to a national bank charter. So we're in, to pardon the horrible pun, we're in uncharted territory here.
Love the pun. Yeah, this is interesting. I think, as Beth pointed out, there's other parallels, like as investment advisors and other contexts where you sort of, transition from being, state to federally regulated. I think practically it's going to be interesting for stablecoin issuers to kind of keep track of this. Right. So taking up very technical securities example, if you're subject to the fair access rules under ATS, you have to start complying with all of these additional requirements. So practically speaking, a lot of alternative trading systems might turn trading off for a particular symbol to avoid getting to that threshold. So it's going to be interesting to see how stablecoin issuers actually decide to implement this in practice. Obviously, there's the OCC rules and other guidance about making the transition, but there could also be a world in which stablecoin issuers themselves decide they don't want to get to that level to sort of try to maintain their reserves so that they stay under that level.
The one last thing is that there is also a presumption for any stablecoin issuer that's licensed in a state that already had a regime in place, 90 days, I think it was, prior to the enactment of Genius. So basically New York, maybe Wyoming, maybe California or Louisiana. If you're in one of those states, there's a presumption that you would get a waiver from this requirement to transition to OCC supervision at 10 billion. But again, we'll see how that actually plays out in practice.
Yeah, I was going to add, I think what will be very interesting for our audience and for us to track is what trends that we end up seeing. So if we borrow from the investment advisors regime, over time, we saw that the states just mirrored what was going on at the SEC level. By way of example, in New York, if you're a medium-sized investment advisor, it's exactly the same as if you're a large SEC registrant, to address that kind of friction that Tiffany was talking about. So it could end up that if you choose the state path, you stay within that business model, or if you're plan to grow, that you end up with a little bit more of a best practices approach, because then the growth will be easier instead of having all of that disruption. And then maybe we'll see that states go closer to the similar. So this way they can get the registrants that can easily grow. So it'll be interesting to watch the trends.
Absolutely. And that's a great segue to the next question. So Beth, what role do you expect the supervisory capacity to play in Treasury's assessment is substantially similar? Could a state have the right rules on paper, but fail to be substantially similar because its examination or enforcement infrastructure are not up to par?
Yeah, I feel like we probably all know the answer to this, but I'll give a little bit more context, which is paper compliance won't be enough. And we already see this because we do have an active state level of supervision for all the financial services that we have been talking about. So the states really are going to need to show that it's comparable to the federal framework. So paper alone won't work. And we talked about some of the sort of indicators of that, which is they really do need to have a fulsome licensing, supervision, exam, and enforcement action sort of framework. But we also see, if we continue with the analogy, that currently depending on what's going on in a different market, some regulators in different states are more stringent than others. And it depends on what the business is, what the registrants are, what the activity is. So I do expect that even though it's going to be more than just paper compliance, if you have a jurisdiction that has less activity and less risks, you're going to have a lighter touch. And again, it will be interesting to see if there is misalignment and there aren't enough resources at the state level to make sure that they maintain the controls and the supervision that's needed. That'll be interesting to track.
Absolutely. And sticking with you, Beth, and we covered a bit of this earlier, but what factors should payment stablecoin issuers weigh when deciding whether to pursue the state level regulation or opt into federal oversight?
Yeah, I do think, and as lawyers, we all start with this. So I'll go ahead and say it's the business plan. It really is what the strategic plan is looking for. And I think we gave sort of 3 good examples that I would reiterate. One, if you do want to service a local jurisdiction and you're not going to need to be across the country or for global remittances, the state path may be a prudent path. However, if it turns out that you're in a state and the state path is exactly the same as the federal path and you have a plan to grow, it seems like more likely than not, the federal option might make more sense because the disruption of keeping track of going from one to the other, it might be a cost benefit analysis. So if you start with the business plan and then you figure out your tailored cost for what the requirements are, ultimately that decision would be made based on the business model.
And Boaz, like, sort of related to the question I asked Beth, 5 years from now, do you expect there to be significant uses of the Genius data, right?
I think there's definitely a use case for it. I agree totally with that. The bigger issuers will use the federal route, and you're already seeing that with a series of national trust bank charter applications. The state pathway will partially depend on what these sort of smaller use cases are that develop, whether they're sort of closed loop systems that for some reason or other still require a Genius license, but also which states I think develop applicable regimes. If we see a meaningful number of states develop regimes where it becomes a real use case, you get 25 states providing this as a pathway. Sure, if you have the handful of states that it looks like are going to develop their own or have developed their own, then you might get a small concentration of state issuers in New York, California, Wyoming, etc. But otherwise, the only option is the federal route. So I agree entirely that it's mostly a business plan decision, but it's also going to be a practical one based on the availability of state pathways in the first instance.
And Beth, if you were advising a stablecoin issuer today, what gaps, ambiguities, or unresolved questions in the proposed rulemaking would concern you the most?
Covered it already, which is if you're going to be launching in this environment where, as we've been talking about for the last half hour or so, there's still requests for comments on a couple of very important issues. So there's still a moving target on the federal benchmark. The OCC rules aren't yet final yet. So that is something that one has to track. We also talked about if you take the state route, you don't really know what the supervisory capacity and how the different states are going to approach their oversight. So that's an ambiguity that you really want to track. And then we talked about capital and liquidity. There's a lot of core components limiting rehypothecation and some of the other things that we had talked about. But there are also in this proposal requests for comment about capital and sufficiency and how it should be measured. And that in and of itself is a pretty core element of knowing what your business plan and your costs are going to be. So those would be 3 that I would highlight.
And Boaz, any other things you would highlight as issues that you expect folks to comment on in the proposed rulemaking?
I think for me, the biggest question mark is what happens at the OCC level, because obviously that sets the boundary for at least half of these requirements explicitly and sort of sets expectations for the remainder. And I think that 400-page OCC proposal from a few weeks ago was significantly stricter than many were anticipating. So I think that there may be comments and questions relating, first of all, to the OCC as the only sort of regulatory guidepost, because people were hoping for a nicer proposal from them, but also all the issues we spoke about a few minutes ago about whether that becomes a changing goalpost and how issuers and how state regulators are meant to deal with that potential.
Excellent. So it seems that there's a lot of things to keep track of and a lot more to come. So as we wrap, I want to thank both of you for joining me today and walking us through the notice of proposed rulemaking and flagging all of the various issuers for our listeners. Any closing remarks before we part?
Thank you for the great questions.
Yeah, just a thank you for including me.
Thanks to you both for joining us.
Thank you for listening to this episode of the New York City Bar Association podcast. Opinions expressed are those of the speakers and not necessarily of the City Bar. If you enjoyed this podcast, please like and subscribe wherever you listen. Find more City Bar podcasts on Apple, Spotify, YouTube Music, iHeart, or at our website at www.nycbar.org/podcasts. Be sure to check out This Lawyer's Life, a professional development podcast where we talk with lawyers about seizing opportunities, learning lessons the hard way, and about what makes them tick. And don't miss Building Belonging, a podcast that embraces authentic conversations about DEIB solutions by amplifying the most marginalized voices in the legal industry and exploring spaces others dare not. This podcast was produced and edited by Eli Cohen.